We've seen a lot of fear within the MLP sector as a result of the falling oil price. And certainly MLPs are indirectly levered to oil prices and energy prices and natural gas prices. However, I think the level of the sell down right now far exceeds the reality of the fundamentals from the pressure on oil prices. The majority of MLPs do not have a lot of exposure to oil. Part of the attractiveness of MLPs is that they have these fixed fee long-term contracts and that they're going to get paid no matter what is going on with the actual commodity. And that's really true of the lion's share of the MLPs out there. Certainly there are MLPs with some exposure to oil. The upstream side of the business, yes, there's definite commodity exposure. Now, having said that, those stocks are now off 40, 50, 60% from their highs, and most of those stocks are fully hedged for this year and most of next year. So again, if oil stays at $50 for the next 2 years, yes, those companies are going to get hurt and probably have to cut their distributions and relook at their plans going forward if that happens. However, the whole reason of their hedging, and again, why there is some safety in MLPs potentially, is that they are hedged and that they can ride this out for 3 to 6 months. And if we do get a bounce back, in our opinion, it shouldn't have a huge effect on them. And away from the upstream MLPs, there's just not a lot of commodity exposure. We see some in the gathering and processing space where companies may have percent of proceeds contracts and may have some volumetric risk. But again, we don't think it's severe. The fear out there that is pushing these stocks down, we've seen a lot of these stocks down 25, 30%. Far outweighs the reality of the situation. We think we're not at all worried about distributions on any of these companies, and we still think we'll see a good distribution growth going forward. If anything, we may see a little bit of a lag effect, which means that if these companies are expecting to grow distributions at 6 or 8% next year, maybe that drops 1%. It's probably not till 17 that we start to see some real effect on growth, and in our opinion, maybe that distribution growth goes down to 3 or 4%. But we think we will see very few distribution cuts across the sector. Again, I think as time goes on and we get a little stability and people get a little bit more comfortable, investors will start to realize that. They'll come back to the stocks, and that should create a nice uplift in the sector.
For more information and data on closed-end funds, visit our sponsor, cefconnect.com, the authority on closed-end funds. This is Closed-End Fund News. Thanks for watching.